Margaret thought she had it all figured out. At 64, she'd saved $850,000 for retirement and was ready to move from New York to Florida for that tax-free golden years everyone talks about. Then she got the bill. $47,000 in taxes she never saw coming. Taxes that weren't income taxes. Taxes that Florida was supposed to protect her from. Margaret called me crying. "How is this possible?" she asked. "I thought Florida had no taxes." Here's what Margaret didn't know, and what 90% of retirees discover too late. There are 5 hidden state taxes that can blindside you in retirement, even in so-called tax-free states. Welcome to Easy Retirement Life, where we uncover the retirement truths others won't tell you. I'm here to reveal the 5 tax traps that caught Margaret off guard, and more importantly, how to protect yourself from losing tens of thousands of dollars like she did. By the end of this video, you'll know exactly which states are secretly draining retiree bank accounts. Plus, I'll share the one tax loophole in Section 4 that could save you more money than Margaret lost. But first, let me tell you what really happened to Margaret. Margaret isn't alone. Last month, I received 47 calls from retirees who thought they'd escaped state taxes by moving to Florida, Texas, or Nevada. They all made the same critical mistake. You see, when most people talk about state taxes in retirement, they focus obsessively on income taxes. It's like going to the beach and only talking about the sand while ignoring the sun, the waves, and the undertow that could pull you out to sea. The financial industry loves this narrow focus because it keeps you distracted from the real wealth killers. Here's what keeps me awake at night. I've watched families lose their entire retirement security because they only looked at one piece of the tax puzzle. They moved across the country, uprooted their lives, left their grandchildren behind, only to discover they'd walked into an even bigger tax trap. Today, we're going to compare 2 nearly identical states, New York with 19.8 million people and Florida with 23.4 million people. And I'll show you exactly how both states are extracting money from retirees in ways you've never considered. Tax number 1, the Social Security surprise. Picture this scenario. You're 67 years old, finally collecting Social Security after paying into the system for 45 years. You think this money is yours, right? Wrong. 9 states have quietly decided they deserve a piece of your Social Security check. Not just any piece. We're talking thousands of dollars per year that these states are legally stealing from benefits you've already earned. Here's what happened to Robert in Connecticut. He was receiving $2,800 monthly in Social Security benefits. Seemed safe, right? Then Connecticut hit him with their Social Security tax. "I couldn't believe it," Robert told me. "I'd already paid federal taxes on this money when I earned it. Now they want more?" The 9 states currently taxing your Social Security are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. But here's the twist most people miss. Some of these states have income thresholds, which means you might escape the tax if you're careful about your other retirement income. The problem? Most financial advisors never explain how to structure your withdrawals to stay under these thresholds. Speaking of money you've already earned, wait until you hear about the property tax shock that's hitting retirees in the next section. Tax number 2, the property tax deception. Now here's where Margaret's story gets really painful. She bought what she thought was her dream retirement home in Florida. Same size house as her New York property, similar neighborhood, about 20% less expensive. She calculated her property taxes based on the purchase price and Florida's low tax rates. Everything looked perfect. 6 months later, the assessment notice arrived. "This has to be a mistake," she whispered, staring at the number. Her property taxes had somehow jumped from the $8,000 she budgeted to $23,000 annually. What Margaret discovered is something the real estate industry doesn't want you to know. Property taxes aren't really controlled by states. They're controlled by hundreds of individual municipalities, counties, and school districts. You could live 3 miles apart in the same state and pay completely different amounts. Here's the shocking reality. New York municipalities collected $66 billion in property taxes in 2023. Florida, $43 billion. But remember, Florida has fewer people. When you break it down per person, Floridians are actually paying more in property taxes than New Yorkers. The average New Yorker pays 1.54% of their home's value in property taxes. Sounds high, right? But in some Florida counties, retirees are paying over 2%, and their homes are being reassessed every year as property values skyrocket. Texas, another tax-free state, averages 1.54% property tax rates. That means a $500,000 retirement home costs you $7,700 per year just to own it. But there's an even more sinister tax that most retirees never see coming. Tax number 3, the sales tax trap. This is where the tax-free states really get you. If they can't tax your income, they're going to tax everything you buy. And in retirement, when you're living on a fixed income, every purchase hurts more. Remember Margaret? She thought she was saving money in Florida. Then she started actually living there. Groceries, medications, home repairs, car maintenance. Florida was charging her 6% to 8% on nearly everything she bought. But here's the part that really stung. When she added up all the local taxes, some purchases were taxed at over 10%. I'm spending $6,000 more per year just on sales taxes, Margaret calculated. And that's not counting the tourist taxes they charge on everything because I'm not a long-time resident. The numbers are staggering. New York collected $20.7 billion in sales tax in 2023. Florida, $44.2 billion, more than double, with a smaller population. Louisiana hits retirees hardest at 9.58% sales tax. Tennessee follows at 9.55%. Arkansas at 9.45%. These states are literally taxing retirees into poverty on every purchase. But wait until you hear about the tax that only hits you once, but can destroy your family's entire inheritance. Tax number 4, the estate tax ambush. Here's the story that changed how I think about retirement planning forever. James lived in New York his entire life, built a successful plumbing business, saved diligently, owned a modest home in Queens worth about $600,000. Nothing fancy, just a middle-class retiree. When James passed away at 78, his daughter expected to inherit his life's work: the house, the savings, the small business. About $1.2 million total. Then the state of New York sent her a bill for $180,000. "Dad never told me about estate taxes," she sobbed during our consultation. "I have to sell his house just to pay the state. Everything he worked for is going to the government." 12 states and Washington, D.C. have estate taxes. If you live in Connecticut, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, or Washington, your family could lose hundreds of thousands of dollars when you die. New York alone collected $1.5 billion in estate taxes in 2023. That's $1.5 billion taken from families who thought they were passing on their life's work to their children. Florida's estate tax collection? $0. But here's the most infuriating part. Even after the state takes its cut from your estate, some states aren't done with your family yet. Tax number 5, the inheritance tax double dip. Just when you think it can't get worse, some states have created the ultimate double taxation scheme. First, they tax your estate when you die. Then, they tax your heirs when they receive what's left. 6 states currently impose inheritance taxes: Maryland, Kentucky, Pennsylvania, New Jersey, Iowa, and Nebraska. Listen to what happened to Patricia. Her father died in Maryland, leaving her his $400,000 retirement account. Maryland took their estate tax first. Then they sent Patricia a bill for inheritance taxes on what she received. "They taxed my father when he died. Then they taxed me for receiving what was left," Patricia explained. "I lost 26% of my inheritance to taxes. Money my father had already paid income taxes on during his lifetime." Maryland's inheritance tax ranges from 0% to 10%. Pennsylvania goes up to 15%. New Jersey can hit you for 16%. These states are literally profiting from your grief, taking money from families during the most difficult time of their lives. Now here's what the financial industry doesn't want you to discover. After analyzing all these taxes, I calculated the total tax burden for each state. New York collected approximately $142 billion in total state and local taxes in 2023. That's $6,068 per resident on average. Florida collected approximately $87.2 billion. That's $4,404 per resident on average. So yes, Florida residents pay less on average. But here's the plot twist that changes everything. In New York, most of your taxes are based on your income. If you're a retiree living on Social Security and modest retirement withdrawals, your New York tax bill could actually be lower than someone living in Florida. Why? Because Florida makes up for their no income tax policy by hammering you on property taxes, sales taxes, and dozens of hidden fees that most retirees never calculate. Margaret learned this the hard way. Her total tax bill in Florida was only $800 less than what she was paying in New York. But she'd given up being near her grandchildren, her longtime doctor, and her support network to save less than $70 per month. "If I had known," she told me, "I never would have moved." Here's what you need to do right now to protect yourself from these hidden tax traps. First, calculate your total tax burden, not just income taxes. Add up property taxes, sales taxes, estate taxes, and all the hidden fees. Most retirees are shocked when they see the real numbers. Second, consider your retirement income sources. If most of your income comes from Social Security and Roth accounts, a high-income tax state might actually cost you less than a tax-free state. Third, plan for the taxes your family will face. Estate planning isn't just about wills and trusts. It's about protecting your family from these state tax ambushes. The most important thing to remember is this: the states will always find ways to get their money. Your job is to understand all their tactics before you make any major retirement decisions. Don't let what happened to Margaret happen to you. Don't uproot your life chasing tax savings that might not even exist. Thank you so much for spending this time with me today. Your trust means everything to me, and I'm honored to be part of your retirement planning journey. If this video opened your eyes to the reality of state taxes in retirement, I'd be grateful if you'd hit that like button and subscribe to Easy Retirement Life for more practical retirement guidance. Please share this with anyone you know who's planning their retirement years. They'll thank you for potentially saving them thousands of dollars and years of regret. I'll see you in the next video where we'll explore more strategies to help you retire smart and live better.